All right, should be live. Everything looking good on my end. Let's go ahead and get this stream started. Welcome back to the channel, Crypto Trend Trader, with our Friday morning market wrap up. Before we get started, I'd like to remind you it's not financial advice. I'm not your financial advisor. Its markets are extremely volatile. Please do your own research and trade responsibly. It is Friday, 11 a.m. Eastern Standard Time on April 22nd, 2022. And boy, have we got a lot to talk about today. So let's go ahead and jump right in, take a look at these charts and see what they're telling us. So obviously, we saw some sudden bursts of strength, some sudden bursts of weakness. But we've been discussing how we're essentially at some key pivot points in the market. And that's what we're going to look at today. So obviously, we have our stocks to take a look at, the main indices. And then we're going to take a look at gold, pot stocks, uranium, energy. Take a look at the DXY and some tech sector. And then, of course, a couple of cryptos as well. And overall, we've been paying attention to a couple things. There were some trade setups that were potentially starting to show up on our crypto charts as we were starting to put in a little bit of bullishness for a potential retest of those daily moving averages again. But would we say last stream, watch the 4-hour, because the 4-hour is looking like it's wanting to get rejected and push back down. And we saw a push up on Bitcoin spot price. 4-hour to try to retest the 200 simple. Failed, got rejected right at the 200 exponential. And now we're rolling over. And it's looking like we're headed down to sweep the lows and potentially go to lower lows. And obviously, at this point in time, the stock market and crypto are trading 100% in lockstep. I mean, you don't even need to look at both. You can just look at one or the other because they're exactly the same. Crypto is literally just another stock at this point in time. It has completely lost any and all of its separation. I think it's correlated at this point in time at actually historically at over 85%. So it literally is just a proxy for the stock market that's open on the weekends. So that being said, we saw a little bit of bullishness coming in this week in stocks and crypto. And then Powell came out yesterday and did a little interview on CNBC and essentially said that 50 basis point hike is on the table for the next meeting. So, obviously that was already priced in because everybody already knows everything and the market is, clairvoyant. So what was the move then? Well, I guess probably just reality setting in because the truth is everybody keeps talking about, and you can listen to a couple people or, talking heads or news or friends or forums or influencers, and they'll tell you, a slew of things. Everything's already priced in. Well, this is priced in, so if it's better than this, it's this. If it's worse than this, it's this. The truth is, what the market thinks is priced in. What the Fed says or what the market thinks the Fed's actually going to do is priced in. And at this point in time, there's still a very, very large portion of the population or investors that are literally saying the Fed cannot raise rates because they can't service debt. Now, I'm not going to go into this whole discussion again because we've had this discussion so many times. I have presented like 3 to 5 different ways that the Fed could service the debt with ridiculously high interest rates. Again, not going to talk about all the specifics of it, not going to go into all the details, but just the basic, tip of the iceberg. The Fed only keeps so much of their profits and then they return the rest back to the Treasury. So even if servicing debt was extremely expensive, you basically have the Treasury paying the Fed then taking those profits, taking out their cut, which they already make anyway, always, and then rolling that money back into the Treasury. So it actually costs them no more because the Fed is already taking, their certain amount regardless. Second would be that they just issue a bunch of quote unquote like war bonds or super long duration bonds. They roll over all the debt into these long duration bonds instead of buying short duration treasuries and mortgage backed securities that are expiring on a regular basis. And then they lock in whatever that rate is that they issue the long bonds at. And then at that point in time, they can do whatever they want with the debt or the rates. It won't matter because they're not taking on new debt like they previously have, because they just took this one big lump sum, debt funding payment to cover them for the next 1, 2, 3 years, etc. So there's a lot of, and that's not even getting creative. That's just two basic things that have been done previously in the past or that are done regularly that immediately just dispel that rumor. So that being said, the fact that we know 100% for a fact that under zero circumstances whatsoever does the raising of rates by the government, Federal Reserve, however you want to look at it, we know for a fact, based on history and based on, rules, math, the rules of the game, we know for a fact there's plenty of things that the Fed and the Treasury can do working in lockstep to be able to make sure they quote unquote service their debt. Not to mention, obviously they can just, create more treasuries and sell them. They just need a buyer, and the Fed can be the buyer and seller of last resort. Therefore, we don't have to worry about that. They can get infinite funding basically because they can just issue more debt in the form of treasuries and then have the Fed buy them. So we know for a fact if they want to work together, there's a 0% chance that they would ever default no matter what the rates are. They could literally raise the rates to 100% tomorrow and it would not bankrupt them because they could just, basically issue more debt or quote unquote print more currency. So there's a 0% chance of default as long as the United States government is world reserve currency. Now, is it possible that they default through devaluation of the currency? Sure, but that's not a technical default. That's literally just, basically inflating away the buying power of the people who, basically bought the loans. But that's always a possibility too. So we know for a fact that there's plenty of things. There's 3 now that we've talked about that they can raise the rates whatever they want. So the whole argument that they cannot raise rates because they cannot afford to service debt, no, that's not correct. They cannot raise rates because you can't service your debt and you'll go bankrupt or you'll lose your house or you'll be in trouble. But not them. They're going to be fine. They'll be fine. You might not be able to buy a house because mortgage rates are going to go up to 10% or 15% or 20%. So you might not be able to do what you want to do, but they'll still be fine. They're going to be okay. The government is going to be okay. So I think more people need to realize that this whole argument that they can't raise rates because they would default is fake. That's a fallacy. It doesn't exist. It's not real. They've raised rates before. They've never defaulted. And they've never even had, even when they raised rates back in, late 70s, early 80s, didn't default. How did they pull that off? Well, the debt wasn't as big back then. Sure, and neither was the GDP, and neither was all these different numbers that we look at. So when it's all said and done, if you don't think that the architects of the system that the entire world is governed under can figure out a way to not go broke by raising rates, I mean, why are you even watching like technical analysis or looking at, important things in the market? If you've already made up your mind 100%, you should just be massively long the most speculative stocks and cryptos and everything like that. So I know that if you're here right now, you believe in like actual like truth and knowledge, and so you don't have to worry about that. So that being said, it's literally an impossibility that unless they decided they wanted to raise rates and not service their debt and default intentionally, there's a 0% chance the United States defaults on its treasuries. So that being said, now we can move on and look at stuff now that we know that that's an actual fact. But before we do get started, just want to say what's up to everybody in the chat. What's going on? Sohail, hello. Hope everyone is doing good, feeling good. Yeah, man, doing good, feeling good over here. Hopefully you are as well. Masoto, say what's up. Good to see you, brother. Hopefully you're doing good. Unique, hey, crypto trend trader, looking forward to the stream. Appreciate it, man. I'm looking forward to it as well. Yoda said, Sandblaster Yoda sending greetings to you all. Sandblaster Yoda. And Sohail says, there is this man named Rick Rule that talks about that after gold goes up, silver will go up much higher than gold because gold is for the savers and silver to the gamblers. He's probably biased. Well, Rick Rule is a legendary investor Not sure specifically what you're talking about though. It talks about after gold goes up, silver will go up much higher than gold. Yeah, I mean, for the most part, that's true. I mean, there's a lot of historical ways to just look at gold and silver. Everything from like gold silver ratio, um, or just commodities in general. And you can kind of get like a rough idea when they're expensive or when they're cheap. And that's the most important thing is like not focusing as much on the exact number of the ratio, but looking at like, okay, historically speaking, gold silver ratio was never at 120. And during the pandemic, it got to 120. So it took 120 bars of silver to buy 1 bar of gold. And then we know like historically, we have things going back, thousands of years. We have like, biblical Roman times, whatever you want to, however you want to look at it. In the Bible, they talk about, 10-to-1 ratios of gold to silver. So historically speaking, if we get anywhere near, 20, 30, 40 silvers to 1 gold, we know that, silver is historically expensive or gold is historically cheap compared to silver. And then vice versa, when we reach something like 120 during the pandemic, we know obviously like silver is extremely cheap, arguably undervalued. So when we see those ranges anywhere under 40 or, over 80, we know we're getting towards like the outliers or standard deviations of like the spectrum. It's not likely that unless there's like a fundamental change in like why we need gold or silver, etc., it's not likely that you would spend too much time below 40 or above 80. So we're at like that 80 level now. So historically speaking, gold compared to silver is fairly expensive. Now, it doesn't mean it can't stay like that for a couple of years. And also, we talk about a little bit, I just mentioned about, something fundamentally changing. You could argue that when we started using paper money or digital money, that a lot of silver's actual use as currency, basically changed. So fundamentally, we used to use silver for smaller denominations of gold. So you didn't have just like a little speckle of gold. You would have like a full silver coin or whatever. So now that that's not nearly as necessary and we don't really use silver for money anymore, you could argue, well, that's a fundamental change that cuts back on the demand for silver. So then you have to take into account, well, how much silver was being used for coinage and then how much has silver's industrial use increased now that we use it more for like microchips and computer parts and, EV vehicles or whatever. So you have to kind of balance all that out. And when it's all said and done, you can look at like the aggregate demand and supply of gold and silver and then what it's used for and what percentage of it's for jewelry or coinage and what percentage of it gets consumed. And when it's all said and done, you could create some super detailed model to figure all that out. But in the end, the easiest thing to do is look at the gold silver ratio. So, but that being said, let's go ahead and jump right in. So we know that the whole argument that the Fed can't raise rates is a fallacy. If the Fed decides it wants to raise rates, the Fed is going to raise rates. And, I've heard a lot of other arguments as well, like, well, they can't do it because it'll crash the stock market. Well, they can't do it because it'll crash the housing market. They can't do it because it's, an election year. And look, the truth is they can do whatever they want. We don't know what their top priority is. We know going into, midterms, elections, we know it looks really bad if there's massive inflation. So if I was behind the scenes right now, whoever Biden's handlers are, I would imagine they're probably saying to Jerome Powell, hey, do something about this inflation or it's your fault if we don't get reelected. So I'm sure he's getting like the blunt of everything right now. So that being said, when we look at the TNX, I mean, this thing is still just going parabolic. I mean, it's at 2.9 right now. We saw it come down a little bit. It cooled off, and now it's just pushing up even higher. Now, we do have to watch. It is starting to roll over. We are seeing some clear bearish divergence between the 2 points right here as it continues to just melt up. But that doesn't mean it can't continue to melt up again and put in a third drive of bearish divergence, etc. But we know it's at some key levels. We know where we're at right now is basically, one of our main targets. We basically have had the measure move all but play out. So at this point in time, the best thing for this, if it wants to see continuation to the upside, is to basically just cool down for a little bit, and then it can see that aggressive move. over time. But shorter term, like on a daily, it's getting pretty tired. Now, this is the key level that we need to watch right here. We talk about it all the time. You guys all know. I'm on the weekly now. That 3.25 level, that's the key level. If we get above the 3.25 level, that's a, confirmation breakout of a downtrend because we took out the previous high after putting in a low. So, we have basically this high right here, and then we came down, we put in a new low, and then we came up here and we actually took out that high on the weekly, and that looked like it was going to be a technical breakout. Okay, and that was coming into like 2018, and that was when we all know what was going on then. The Fed was tightening, and then obviously the stock market started underperforming. Trump started putting pressure on, Fed Chairman Powell. Powell pulled back off of it, and then that led into like the Rona dump and everything. And again, we put in a new low. So we actually technically, on the weekly chart even here, took out that previous high. So that should have been technically a breakout. But really, was this just part of the same move? It's what it comes down to. So like this we hadn't actually put in our low yet. And then we came down and put in a new low. And then when we came up, we took that out. And it's like, oh, that's a breakout. We're going to the moon. And then everything rolled over. So is it possible we get the same thing happens again? We could come up here to 3.24 or whatever, take out that high, and then it just rolls over. And it's not a breakout or it's a failed breakout. It's always a possibility. But if we look at the difference of what the chart looked like here, the speed and velocity, and then we look at what it looked like here, this move looks aggressive right now, and it looks like it's strengthening. I mean, the intensity, here we started kind of moving up, and then we just started going straight up. And then we cooled down for a little bit, retest some key levels, and then we break out, and now we're just going straight up again. So the strength of this move, once we take out 3.25, or if we do take out 3.25, it's going to look like one of those big moves, the breakouts, what they look like. When you approach that resistance with this much intensity, imagine a car trying to drive through a concrete wall. Well, you start 5 feet away and you only allowed to hit the gas 10%. You're not going to break through a concrete wall. You're just going to kind of bump into it. Well, now you start 10 feet away and you're allowed to hit the gas 15%. And you're like, okay, yeah, you might crack it. You might do a little damage, whatever. Then you start 30 feet, 50 feet, 100 feet away. And now you're allowed to use the full throttle. So that's the difference what we have right here. We have this wall and we're approaching it. And we're approaching it going, 150 miles per hour at full throttle right now. We're not just kind of creeping up to it. We're not just kind of bouncing off a level. We're not consolidating at that level. No, I mean, we're full on, maximum velocity going towards this wall right here. So we still expect it to slow the car down a little bit. We still expect to do some damage. We expect it to act as resistance when we get there. But the velocity that we have, the intensity that we have approaching that is something we haven't seen before previously. And it's because of that V bottom. And we see here now on the weekly, we've actually flipped over the slope on the 200 simple for the first time. So we have technically confirmed back into an uptrend on this weekly. And then obviously everything else is very strong for the weekly. And then we look at the monthly. Again, and I only show this chart every single time for a reason because it's so important. We've broken above the 200 exponential and 200 simple for literally the first time. And now we're above the 200 exponential. 200 simple is basically flat, so it's about to flip blue. 200 exponential is already flipped blue. And we see the strength of this as we're flipping the slope on the TJD TDMACD blue, all green histograms, going parabolic, accelerating to the upside. We have obviously the stochastics angle to the upside inside the bullish control zone. Everything is very, very bullish right now. Now, we see the knife sticking through the air right here. When we see these massive pushes on the knife, that's where we look for potential tops. Now, we can look back here and we can see we've had higher tops before, but this is going back to like 1979. So this is where we got like that blow off top level previously. But even though we saw the knife come up here and we saw that blow off top, we actually saw the knife create divergence one more time, and that was the final top. And we still accelerated quite a bit higher to the upside. We still went up like 9% from then to the upside on the interest rates. So even though it's looking like, oh, we're probably getting close to topping out, I mean, this could still take another year. The knife is just telling us, hey, what we're doing right now is not really sustainable. We're seeing a massive move in this asset currently, the massive move can't continue, and it's probably going to print some divergence into the future. But, we know obviously these markets can keep running a lot longer than you can just, fight them. So that being said, on the monthly here, we're definitely watching these key levels, definitely paying attention to, getting above that, 3.2, whatever level we want to look at. These are key levels, 3.2, 3.4, depending on what time frame we're on, etc. But the argument that the Fed can't raise rates, the market's raising rates for the Fed. It doesn't matter what the Fed does now, market's raising them anyway. So we go over to TLT, we see we basically broke through that bottom support, came back up, retested it, and now it's having some trouble. Now, a lot of times what will happen here is we'll see some kind of exhaustion show up in this chart, and then that will mark the bottom. Now, the question is, does the exhaustion show up slightly lower at like that 117, or is this it? Regardless, the way this move has played out already, I mean, I don't want to start fighting the trend and trying to pick bottoms right here or anything, but if we just look at our measuring tool and we say, okay, maybe we're going to go a little lower, retest the bottom of the range. I mean, we're 2 to 5% from the bottom of the range on our target right here. So we're going to know pretty quick if this is going to hold or not. If it goes more than 5% to the downside, it's probably going to be really, really bad for bonds. And then we know realistically, if we bounce somewhere around this level, we're probably going to come back up here and retest like the heart line or, the breakdown from our green support. So, we're looking at 2 to 5% downside to find out. And then we're looking at, 10% upside for just like a mediocre retest. So at this point in time, we're starting to look at like 2, 3, 4 to 1 risk reward ratio from this area to actually be long bonds. Now, I'm not saying I'm taking that trade necessarily by any means. What I'm saying is that it's not unrealistic to think that we're going to see some kind of inflows into the bond market as sort of like a dead cat bounce at key levels. So that's what I'm paying attention for. So there's a lot of things that can cause stocks or bonds or, dollar or crypto or whatever to go up or down. This is a key factor that would cause a lot of those things to go down if all of a sudden we see, net outflows from the bond market turning into net inflows again. So it's definitely worth paying attention to there. Now, we talked about a lot of the long-term like headwinds and tailwinds and all that stuff. You guys know how I feel about bonds in the long term. Reward-free risk. You take all the risk and you get nothing for it. You're not beating inflation, with the pathetic little percentage that you're getting on the coupon or the yield. You're not going to beat inflation. So you're losing money guaranteed. And then on top of that, there's massive danger to like your actual principal, speculating on these things as well. So, in my opinion, not a good place to be right now. That could change going into the future, but what's it gonna look like when it changes? Well, maybe they're paying 5%, maybe they're paying 7%, maybe they're paying 10%, and then it's like, okay, now it's worth taking a risk for 10%, and when inflation's at 7 and maybe starting to top out into the near future. I mean, I'm not saying it is, but that would be a hypothetical situation. Say 2 years from now, bonds are paying 10% and inflation's coming back down to 5 or 4 or 3, all of a sudden they might look good. But until that time, I don't see inflows like picking up like long term until we see some kind of switch. And that's just further proof that people are being pushed further and further out the yield curve, because obviously bonds are supposed to be low risk, stocks are more risk. So if bonds are not paying as high a yield as the stock market is, an index like the S&P or something like that, well, why wouldn't you just bet on the S&P? The S&P always goes up and it pays you the same amount as the bonds. I'll take that. So next we have U.S. oil. Still doing not really anything. We're seeing still that lower high. We've technically broken out of the triangle, but this is more of a, I don't want to say that the descending resistance line doesn't matter, because it does, but it's more the idea of the triangle than the actual like exact shape and everything of the triangle. So when I say the idea of the triangle, I mean that obviously it's just a high, then a lower high, then a lower high, potentially again. So that's much more important than the actual resistance line that we're looking at. So, I mean, it's always worth watching, the descending resistance, but we don't want to respect it as much as we're respecting this level here as that next lower high. So next we have the Dow Jones. Obviously, we are seeing some extreme weakness going into the close this week. So we had a decent pushback up, a retest, reversion of the mean, tried to poke back up, tried to put in a higher high, failed on some indexes. We did it on others. And now we're seeing two just big, thick, red, juicy candles. Not what you want to see if you're a bull in these markets. So once again, buying the dip has failed. We're seeing some weakness on the stochastics. They probably still cross right here unless we get a pretty aggressive move down. I mean, this is fairly aggressive, but didn't technically print divergence here because we have a lower high and we have a lower high here. So we're seeing convergence. But again, we just have that series of lower highs and, lower lows. At this point in time, it's likely we come back down here and put in a new lower low. And that'll give us our retest of like that purple resistance. That actually would look pretty good, depending on how you're looking at it. But if we look at our weekly chart right here, we're seeing we got like the hard buy on the weekly, bunch of green histograms in a row. But look at this weekly candle. You trust a hard buy when the weekly candle is a clear rejection? I mean, this is literally textbook rejection. So we see right here, the absolute top was that exact candle. And we call that the shooting star. Obviously, picture, a star or a meteor or whatever falling from the sky. And you have like, a mass, a ball of mass. That's our body. And then it leaves behind it a tail. That's like for like a comet or something like that. That's our tail. That's basically our rejection. So when we see that in the sky, when you see, a piece of mass coming towards the earth in a hurry and it leaves the tail behind, that basically shows where it's coming from, the same way these candles work and show like a rejection. So we moved up to higher prices and got rejected. So now we can see the way the market looks at this candle, or the way the market has printed this candle, gives us an idea as to the trajectory of the comet or the shooting star or the mass. So essentially, when we see the tail behind it, we can tell which way it's going in. So that's what we see here. We see the mass, we see the tail behind it, that rejection to the upside. So that tells us the direction is probably going to continue down. The same way, I mean, this one, it came down a little bit, filled back in that tail a little, and then shot to the upside. Here we see, rejection here, and then continues to the downside. Typically, the direction of a hard rejection like this with a small body on it, especially if it's red, that's basically everything pointing to the downside. So does it have to happen? No. Does it look likely? Yes. And, obviously, it's all about, with a single candle, it's the least reliable thing you can look at. When you have a candle pattern, multiple candles aligning up in a certain way, it tells you the psychology of the market. It's a little more reliable. And then eventually you get into like more complex patterns, indicators, oscillators, all that stuff. And then you just look for confluence on those things. So what we see here is we had the 8 and 21 cross to the upside. Everything was green. And then here we crossed. We tried to avert the cross and got rejected twice. And when we got rejected twice, they crossed the downside. We tried to come back up, save the trend. And then we got rejected a couple times. It fell over. We had one massive push up. The bulls came in. They said, we're going up. We're going up. Let's do it. All the bulls get together. Everybody hold hands and sing kumbaya. And then what happened? The bears showed up, grabbed hold of all the bulls, tore them to shreds, chewed them up, spit them out, left. The bulls came back, tried to do something again. The bears came back again, beat them down. And now where are we at now? Bears are in control. The bears are in complete control. So we have a hard buy signal right here. Do we believe it? I don't think so. Not while the 8 and 21 is getting rejected. Not while we can't even close above the 8 and 21. Not when we have this massive rejection candle like this and we're 4 hours away from closing the week red. Now, what could happen? Well, we see continuation of downside. That still looks bearish. If we close back above 34,676, maybe it looks okay. We at least closed a weekly above the 821, but we still have a massive red candle. Maybe this whole thing gets bought back up and turns green. Then we're talking. Then I'm bullish. Then it looks good. But if we print this candle how it is right now and we close below the 821, the weekly looks absolutely terrible to me. Looks absolutely terrible. And I mean, we still got about a week left on this month, but what really happened? Well, we said we'd come down, touch the 21. Then we said we're going to come back up and probably get rejected off the 8. And now here we are, closing back down below the 8. So when this monthly closes, If we're below this 8, if we're below that 34,639, it's just going to look like this was a reaction rally. This was that slinky theory. We come down, we get a move back up, but it takes us to a lower high, and then we're going to come back down again. So it looks really likely that we're about to lose that move that we just had back to the upside and go down. And when we look at the monthly, we see the hard sell. We left the bullish control zone. The Stochs are angled to the downside. We have all red histograms. The slope has already flipped from blue to red. Doesn't look good. Does not look good. We know for a fact, and again, we've done this over and over again, and I hate to be like super repetitive, but sometimes that's how you learn. You know, when we see this signal show up, that was a pretty massive move. When we see this signal show up here, you know, we actually went slightly higher a couple times and had a pretty massive move. Here we see it. Here we see it. Here we see it. So the danger of ignoring this hard sell, in my opinion, is far worse or far more than the missed upside if we're wrong and this thing goes back to new all-time highs. Because if this right here plays out, let's just look at a couple extreme examples. If we see that hard sell play out, you know, and we get a situation like this, you know, we're talking about a 55% move like we saw in 2008. 55% move to the downside. So you lose half your money because you were greedy, because you didn't trust the chart. Here's our Rona dump. 38% to the downside. So that's two pretty extreme examples. So average, you know, 38 to 54% to the downside. So we'll just call it, you know, 45 to 50% downside. I mean, I don't want to risk that. But what's our upside potential? I mean, right where we're at right now, if we just bought and then we went to new all-time highs, you know, what's the upside potential? 7.5%. So we have 7.5% upside potential right now. At which point in time, if we take out the high, we're like, oh, well, we just took out the high. So bullish, blue sky breakout, let's go. But what's our downside potential? You know, we've already come down at this point in time 7.5%. But, you know, if we're talking about downside potential of 40 to 50%, we're talking about a retest of 200 exponential and simple on the monthly. Well, there's no way that'll happen. That would be horrendous. That's a crash. Well, I mean, when we look back at this chart, do we ever see a retest of 200 exponential? Well, here we see one. Here we see one. Here we see one. Here we see one. Oh, that's crazy. So I guess it happens all the time. That's insane. Look at all the times we retest it along the way. So, I mean, just because we're up here way away from the 200 exponential and simple doesn't mean we're not coming back down to test it. Because we know on a long enough time frame, it's an absolute fact. It is a 100% fact. No speculation, no guessing. We can literally just sit here right now and say, on a long enough time frame, we know for a fact with 100% certainty that eventually, on whatever time frame we're looking at, we know for sure the price action will eventually touch the 200 exponential and simple moving average. We know it for a fact. It's done it every time. You know, the last time it did it was in 2009. So it's been a while. It hasn't done it for a while. So does that make it more or less likely? Well, I mean, 1982, it went all the way till 2009 without touching it. So, you know, that was 27 years. So it went 27 years without touching it. So if you're waiting on that touch, you were probably disappointed for 27 years. So does it mean it has to do it now? No, it does not at all. But there's at least a decent probability or possibility, and the risk reward is so strong to the downside right now that I would rather wait for a blue sky breakout and a new high before I would just assume that this correction is going to be over. So that being said, that's my rationale. You know, and then obviously also we just closed the daily back below 200 exponential and simple. They're back red and pink again. We're back in the bear market confirmed. So looks, I mean, doesn't look good to me. So we talked about a potential setup for SPY. Obviously, you know, coming down here, putting in what amounts to, you know, a inverted head and shoulders, still a possibility. You know, this was the area we were watching, 428, to see if it comes down below that area. It's going to look weak. We typically like to see the direction of the shoulder lining up with the direction of the neckline. So if we see an upward sloping neckline, we want to see an upward sloping shoulder. That's not what we're seeing if we go much lower right here. So, and that S&P has been staying the strongest. We see another clear rejection off 200 simple. 200 exponential is already flipped over bearish. The 200 simple, I mean, at this point in time, we can see, I don't know if you guys can actually see my cursor that well. But like if we just take a horizontal line and just put it on the 200, we see it disappears right here for the last like 5 or 6 days. So it's basically flat. At this point in time, 200 simple is flat. So if we literally just spend a couple days underneath this, it flips over bearish and we confirm into a bear trend on the S&P as well. So, you know, pardon me if I'm not particularly bullish. So here we have IXIC, NASDAQ. This was the same thing. We talked about a potential inverted head and shoulders. You guys know we're looking at trade setups. This is not my base case. My base case is we go much lower. This is a counter trend trade that I specifically said I'm not taking, but there's an argument to take it. And that's why it's important to look at when you have a 4-to-1 risk reward ratio to at least evaluate that, because even if the probability of success is below 50%, which it is, because we're below 200 exponential and simple, so we're naturally bearish. Even though it's below 50%, a 4-to-1 risk reward ratio tells you, well, if it's 60-40 or 66-33, and it's a 4-to-1 risk reward ratio, technically it's still a potential for a profitable trade. Because if it's going to happen bullishly 1 out of 3 times and bearishly twice, but it's paying you 4-to-1 risk reward ratio, you actually do better taking that trade. But for me, I like confluence, so you know I'm not really interested in taking that trade. Turning off the drawing tools though, we see what the NASDAQ looks like. It looks terrible. 200 exponential and simple, strengthening to the downside. They're moving back away from each other. They started to converge a little bit. Now they're diverging again. They're rolling over. We're in the bearish control zone. All red histograms. Flip the slope. I mean, everything on this chart is pointing down. And you're like, yeah, but we're already at the bottom of the range. Well, look, we go real low. We get much lower. This was our flip that we've been talking about, where we see all red, and then you start to see more and more green, and we see more and more green. That's telling us the bears are in control. The bears are in control. The bears are in control. The rest of the time, it's all gravy. So here we're seeing, all of a sudden, the bears are in control more than they've been this whole entire time. So if this was our run up from the Rona, and we see this green right here, is when the bears were in control. That was our bottom. And then we see the next time we had that happen was in September 2020. And then we see since then, it was pretty much all red. We had a little flash right here in May of 2021. We had a little flash right here in October 2021. And then now we start seeing, wait a minute, we're actually getting quite a bit of green showing up right here, telling us maybe the bulls are losing control or the bears are gaining control. And now here we see these two last times, the most strength in the bears, this entire trend. So this was the strongest the bears had been. Literally, they had control for the longest amount of time right here in the last, 2 years, year and a half. So that's telling us, okay, maybe we're getting close to a top. And then also we're breaking down below 200 exponential and simple. And then we have reversion to the mean, rejection twice. And now bears are back in control again. I don't like that. And now we're seeing divergence on the chart, bearish divergence as well, below the 200 exponential and simple that are flipping over red. Doesn't look good to me. So when we look at this on the daily, it looks pretty bad. When we look at it on the weekly, well, we still have the 821 cross. Tried to cross them back, got rejected. Looks like we're coming down to 200 exponential and simple. So for this, it's actually a much smaller move to retest some of these moving averages because it went sideways for so long. It was super aggressive on the way up and then came back down and kind of cooled off. And now when we switch over to the monthly, we see the same thing again, but here we're still way above the 200 exponential and simple. I mean, we went parabolic. Now we're already down below the 8 and the 21. Now we had a couple of false alarms previously, so it doesn't just mean we're going to break and go back down and retest it. But we know here our last retest, was in 2009. Before that was in 2002. So these were two pretty substantial crashes. Obviously, this was 2000 crash. This was, the housing market crash. Both times we hit the 200 exponential and simple. So if that case is to happen, it's going to be another, obviously the 2 times we see on this chart where we retested 200 exponential and simple were 2 pretty big deals as far as like finances and like, world economics and whatnot. So if we see a similar situation like that, we know that this has, the snowball has turned into an avalanche. Now, do we have to go lose 50% of the value in the NASDAQ? Do we have to go down to 6,400? No. Is it possible? Definitely. Does it seem likely right now, looking at these, momentum indicators, I mean, look at this thing. It's accelerating to the downside. I mean, this is an intense slope to the downside. This thing is crashing hard. We look at the histograms, all red. You know, we're at a potential area that we would like to see a bounce off the blue slope line. Doesn't have to happen though, and the slope line is basically flat at this point in time. I mean, this is a pretty mean monthly candle right here. Again, a lot can happen before the end of the month, but if we close below the 8 and 21 and we close a new low on the monthly, it's going to look real bad. These markets do not look good right now. They really don't. So we have the Russell, been operating inside this range, currently at the bottom of the range, or technically outside the range. This thing's pathetic, so we expect this to just roll over and go straight to zero. We talked about basically how this works. Essentially, you get a lead in, then you have a consolidation back to the upside, and then typically you break and you get another move like that lead in, and this will be like an A, a B, a C correction. So we're looking for a target on the Russell of like the 382, 1,721. I mean, that's another 10% off the top. After that, probably closer to 0.5. I mean, this thing's going to get hammered. It looks like it wants to just get completely just turned to mush. So the indexes don't look good right now. I mean, the S&P is holding on a little bit, but none of them look good. None of these markets look good at all. And we talked about this last stream on Wednesday. We talked about this. Everything's priced in. The market already knows. It's all the bad news is already priced in. Okay, sure. So what's the good news going to be that makes these markets go up? And then what's the bad news that can make these markets go down? Well, we know what the good news would be. Everything's okay now. The war's over. The Federal Reserve gave up. We're going to send out more money to people. We don't care about inflation. It's fixed. That's like good news stuff. Does any of that seem likely right now? Does any of that seem likely? Not to me. None of those things. I don't think the Federal Reserve's all of a sudden going to be like, oh, we're doves again now. Everything's cool. I don't think inflation is just going to go away and they're going to be like, oh, there's no more inflation. Everything's cool. I don't think the war's just going to end. I mean, have you ever seen a war before? Have you ever experienced a war? I mean, they don't just go for, oh, we're already a month in and Putin hasn't even won the whole country yet. So he's doing terrible. Well, I mean, do wars end in 1 month? They end in 2 months or 3 months or 5 months? Do they go on for 10 years or 20 years or 50 years? I mean, in my experience in life, typically wars are just long and drawn out and they just suck and they last for years and people are just constantly dying and, you know, everything sucks for those countries and it causes a bunch of global turmoil and it's not easy to clean up even after it ends. So I think it's very unlikely that all of a sudden this war is just over. I think if anything, there's probably a higher likelihood that it escalates. So if you're one of the people that's like, oh, Putin's losing, he's going to lose the war soon. Well, let's hope he doesn't lose the war. Not because we want him to win, but because we don't want him to get pissed off and do something crazy. You know, he's already like testing nukes and stuff like that. It's like, oh, those nukes, we're not worried about those nukes. I mean, it only takes one, guys. It only takes one. So I don't see a lot of things that can make the market all of a sudden bullish, but I could think of a lot of things that would make it bearish, where the Fed's more bearish than they thought. Inflation numbers are worse than they thought. I mean, there's tons and tons of, the war's escalating. There's a lot of things you can think of that would make the markets do worse. Not a lot of things that seem realistic that would make the markets do better. So if you're praying on fundamentals and hoping on that, it doesn't look good right now. So XLE energy, I mean, we made it up to our target finally. I mean, technically it's the bottom of our box. So we tagged it a couple times. Really wanted to see it come up to our exact line just because I'm a perfectionist. So maybe we get back up there. Maybe not, though. This is close enough. Close enough. We have some clear bearish divergence developing. This is our third drive. 1, 2, 3 higher highs. 1, 2, 3 lower lows. We were talking about this ahead of time. This is not some surprise. It didn't just all of a sudden roll over, completely unexpected, and now energy's crashing, and it's like, wait, why is energy crashing? Whoever expected this? And we saw it all coming. We've been talking about, literally, when it was back down here, we said, this thing has to come up and take this out, or it's going to print bearish divergence. So it has aggressively rolled over now. It got rejected once again off the slope line, as expected. 3 drives, bearish divergence. Now we're going to look at these key levels to see it come down to the blue slope line, potentially 200 exponential and simple. Still very bullish on energy long term. Short term, obviously, looks like it's stopping out as expected, as predicted, as discussed. No surprises. XCN transportation obviously looks very toppy, under the 200 exponential and simple. We've talked about this quite a bit. Looks terrible. I expect it to go much, much lower. XLF financial, everybody's talking about, well, this doesn't make any sense. Why aren't the banks going up? The banks are supposed to go good in rising rates environments. Oh, I just can't figure it out. The market's just being irrational. That's like all the stuff I'm hearing right now. We have literally discussed countless times how these conditions are terrible for banks, are horrible for financial institutions, and we've literally just seen this continue to melt down while other, talking heads, I don't know if they're liars or if they're just not educated or what the deal is, but the fact of the matter is, a lot of people out here saying, no, the banks are going to do really good. This is really good for financials. Everything's gravy. So the banks that just did a record number of refis, which is where they make a decent amount of their money, a record number of refis, and now rates are going up. So they're not going to be doing any more refis. So that business is completely gone because no one's going to refi at 5, 6, 7%, because that's like historically, like for the last 10 years, we haven't had interest rates that high. So now people are going to refinance? Yeah, how about no? They were just 2%. If they didn't refinance at 2%, doubt they're going to refinance at 5, 6, 7, 8, 9, 10. On top of that, obviously, if we see these rates going through the roof, it's bad for the economy. So then banks are going to pull back on their lending. So that's less money that they make because now they're not going to be issuing any new loans. Finally, the rates are high and they're like, oh, hooray, let's issue out loans. And they're like, yeah, but it's super risky. Let's not issue any more loans. Or we'll use like super stringent requirements. So does it seem like they're going to be issuing more loans? Are they going to be creating more money, more debt, or less? Probably less. So that's not good for banks. And then where's the rest of the money from the banks come from? Well, from speculating on assets. They borrow your money. You think that they're going to go loan it to somebody else for a business or for a house or whatever when you put your money in the bank. But that's not what they do with it. No, they give it to the Fed for overnight interest rates, or they take it and that might be going away real soon with quantitative tightening, QT, or maybe they speculate in the stock market or do, buybacks or, depending on how they spend their money, their profits, the money that's loaned to them. So if the equity markets aren't doing good, the housing market potentially not going to be doing good, refinance is not going to be doing good, loan issuance not going to be doing good. So how are the financials going to do good? Oh, they're not? Oh, okay. That makes sense. So, I mean, just be careful of the narratives that you hear from all these talking heads, all these people telling you buy the dip on banks. Because when I look at this chart, when I look at the financial chart, this looks to me like the beginning of a bear market. I mean, this was the beginning of the bull market, and look what happened. It was great. And now it looks like we're at the beginning of the bear market. Again, rejected off 200 exponential, about to be flat right here, about to confirm into a bear market. So, I mean, how far are these going to go down? I mean, I don't know, but it doesn't look good. I mean, if the bottom's right here and the top's right here, just a retest of the 236 is 33.90. We're at 36 right now. 382 is at 29. So it looked like they're about to lose another 10, 20%. Probably pretty quick. So XLV healthcare. So again, I'm still bullish on healthcare long term, but we've been talking about this scenario playing out right here. So it looks like basically we just put in a third higher high, and when we look at it on our longer time frames, we see once again clear weekly bearish divergence. One drive up right here. We're very, very high on the indicator oscillators. Another drive up higher right here, and we are lower, clearly lower on the indicator oscillators. And then again, a third drive higher. So we have 3 highs, each higher than the previous. And then we have 3 highs, each lower than the previous. So again, we see 1 drive, 2 drive, 3 drives of bearish divergence developing on not one, but both of our indicators. This one is still technically angled to the upside, but it looks like it's rolling over as we speak. So again, 3 drives of bearish divergence on healthcare sector. So again, strong bearish move to the downside likely. I would say so. Already starting to play out. And we talk about these scenarios before they happen, what we're looking for, what we're expecting. That way we can be positioned for them accordingly when we're going to buy the dips or when we're going to sell rips, etc. That's why it's so important to be ahead of these markets. XLP, we've got that consumer staples, still very strong. Just put in a temporary high right here. Looks a little bit tired. Don't want to get bearish on these. I think this will probably stay one of the strongest. Again, these are our safety plays for a potential recession. XLU, same thing, still very strong. We talked about a retest of the heart line. We're at it now. If this area holds, I expect it to go higher after a little consolidation. If it breaks, I would expect potential retest of like that 70 to 72 range. Again, still very bullish long term on that. XLRE, real estate could go either way here. There's two scenarios. You know, we basically put in a lower high and it rolls over and then it doesn't look good, or we come back up here and hit the head and then take off. So don't want to really fight this as it's pretty strong overall, but it does look like it's starting to roll over. It's putting in some temporary bearish divergence. Would have liked this to be like a little cleaner if it was going to top right here, but a lot of times it'll look like it's going to top and we'll see like a pretty clear pattern, and then it'll push up one more time, take out all the stop losses of people that thought it already topped, and then it will roll over. So if you were going to take this short trade, you know, essentially, and didn't take it yet, you have a potential better entry point for it. Now, is it more or less likely to play out right now? Well, it depends how you look at it, but it could still go either way as far as I'm concerned. I would think, honestly, I think this is going to roll over either with a double top or lower high, but we have to wait and see. It's not like some massive risk reward ratio where it's like, oh, it's worth a stab anyway. But it looks to me like this is going to basically get rejected and roll over. But again, we'll see. VWO, Vanguard, FTSE Emerging Markets ETF. So even though China had a little bit of strength here, you know, we talked about this. It looks like it's coming back down to sweep the lows. So I fully expect this to put in new lows sometime in the near future. Still got our target at the 0.5, 41.20 on track. DAX, Germany, looking okay for now. Looking a little stronger. I mean, still below 200 exponential and simple. It's kind of throwing some mixed signals because it looks like it wants to put in a hard buy. It does have a blue slope line, but these are obviously lagging. As long as it's below 200 exponential and simple, you know, it looks like it's going down. It already tagged the 382. So we really want to see either the 236 on the macro hold right here, or we want to see the 382 hold, or else it's going to the 0.5. So this thing looks like it has a lot more ways to go down than it does up. CN50, again, looks like it's getting ready to revisit these lows. Saw a little strength in China today, but it's basically just retesting resistance. It looks like it's basically, I don't want to say it's accelerating to the downside, but it looks like it might be ready to. Definitely showing some weakness. And there's UK rolling over. So we talked about this potential double top. Not only did it double top, but it printed bearish divergence. So we see a higher high here and a lower high here. And we see a higher high here and a lower high here. So again, double top with bearish divergence, all red histograms, hard sell signal. You know, looks like it's coming back down to test key levels. So you would expect it to hold either at 7,400 or 7,300, either this ascending yellow support or the 200 exponential and simple. Not particularly bullish on this in general, but it has been strong in comparison. And then EWZ headed down to our target. So again, I still think this is going to be a buying opportunity. We don't want to try to catch a knife on this thing, but we're looking for this green box or red support to hold, or essentially the 200 exponential and simple. So we want to get this around like 33 bucks. At that point in time, I think on the macro, it's probably going to find support at a higher low here, anywhere higher than these previous two macro lows. So it could be way down here at like 30. But wherever it finds support next, we're looking for it to come back up potentially and, you know, break through this horizontal. So does it have to happen? No. There's a lot of bullish tailwinds for Brazil in general. And there's a lot of ways that you can look into that and see should it be going up or down. Obviously, we know they have a lot of exports and a lot of them are commodities. We know commodities have run quite a bit already. So the real question is, are they making more or less money selling all these commodities? Are they having any issues with, transportation? Like, are they in the middle of a war? No, they're not. Okay, so it's probably going to be easier to get commodities out of there. What's the stability of the government look like? Well, they got an election coming up. Could kind of go either way. Are people talking about Brazil? Are people paying attention to Brazil? Are people looking to invest in Brazil right now? Or are people thinking maybe we should be pulling out of Brazil? You look at some of those macro factors and can get a better idea of what smart money is going to do. And the truth is, it could go either way right now. Obviously, elections in, some countries make things a little crazier than others. But overall, I think Brazil is probably going to be a decent diversification investment, assuming we don't go into some macro, recession, depression, like horrible scenario that kills demand for all these goods, because then this trade fails. But honestly, I think this is going to be a buying opportunity, at least short term, for a scalp that may develop into something else. So we'll have to wait and see. So what do we got going on over here? So Heel says, kudos, thank you for sure, brother. Big D says, hey, what's happening? Good to see you, Big D. Peter Gerd says, I'm watching 23 minutes behind just to make sure I don't miss a second of your stream. Awesome, man. Good to see you, brother. Big D says, I do that too sometimes, Peter. Yeah, for sure, man. You definitely got to watch it in order because my rants typically like line up with the message that we're like overall looking for. So DXY, I mean, this thing, you just can't kill the dollar. I mean, I really thought it was at least, I mean, we came down and touched the 21. That was our first target. But this thing is just ripping. This is the ultimate safety trade right now. You don't want to be in currency, but if you are, you want to be in the dollar. And that's why the DXY is just so much stronger than, all the Western. So we saw a little push up here with everything going on with Tesla. They obviously got their little beat. Everything looked pretty good. And then it just completely sold off. So this doesn't change anything for me. The real question is going to be, does Tesla close below the 8 and 21? The weekly is really more important at this point in time. The weekly still looks decent. I mean, it's holding above the 8 and 21 for now. It is just another lower high, though. So how does this really look? Well, we know if we come up below the slope line and it's blue, it typically rejects. So it looks like we're probably going to get rejected more often than not. So is Tesla kind of priced in with everything that just happened? They're beat. Elon's acting crazy, trying to buy some tweets. It looks okay. I think it probably goes lower from here. I think there's a real possibility it goes to 900. I still think that's a target. So we did it. We did it on ARC. Oh, not quite. Hang on. I was about to give Kathy kudos. Not quite. So close, Kathy. So close. So she's almost about to win the new low medal for her ARC fund. Not quite. She hasn't done it yet. Pennies away, though. Pennies away. So 50 cents. If it goes 50 cents lower, we'll be at a new low. And anyone that bought the dip has now officially lost all the dip money and will be in even worse position. So just when you thought ARC couldn't get any worse and Kathy couldn't do a worse job, she's about to outdo herself. So congratulations, Kathy, on being the worst investor. SMH, new low. Looks terrible. I expect much lower lows on the semiconductor space. Looks absolutely terrible. And now, if we are looking for bottoms on some of these that are getting beat down, one, we don't want to just jump right in right away. And two, we want to look for, some kind of bullish divergence. We want to look for key fib levels for like a pivot. We want to look for like important things. So like NVIDIA here, are we excited to be buying the dip on NVIDIA when it's literally crossing into a bear market, confirming bear market, and putting in new lows? No, we are not. So the last time we bought 200 on the pullback, sure. This time we're not doing it because we're pulling back to the same area again. And you guys know I have some macro lower targets for NVIDIA. I really do think we're coming back down here to like 175. Now, will 175 be a buying area? Well, that's the 618 of this potential like 5-wave structure that's been playing out since March of 2021. So does it have to play out like that? No, but looks likely that if we get an opportunity at 175, I think that's probably going to be a nice area to load back up, at least for a bounce. Again, though, doesn't mean that has to be like the macro low, but we should at least be able to scalp, a quick little 20% off of it and then see how it develops. So that's the area I'm watching. But again, I think when these semiconductors roll over, these things are very, very cyclical. So, when the cycle's over and it's done, there's a way to go. And it's to the downside. So Netflix, we talked about Netflix. I've been talking about it forever and how big of a piece of trash it is. I was talking about it up here. We capitulated. Couldn't even fill the gap. And then, we talked about it here and how much of a piece of trash it is. I mean, for weeks, I continued to talk about how Netflix is trash and, they're just going to lose money and it's going to just capitulate. And eventually we got that right with the earnings report and, of course, capitulation. So where are we going from here? So we saw the Netflix capitulation the first time. We saw it the second time. So where's the target? Well, there's not a lot of support along the way here. So you see that what happened basically was we had a consolidation area around like this 126 level for a decent amount of time right here. We consolidated around and then eventually broke out to the upside. But then once we broke out to the upside, we basically just kind of melted up. So we're below all the support now. There's no real support. So we have some price action that took place right here, but not really. So, I mean, at this point in time, when we zoom out and we really look at the macro, I mean, we're below the 236. So unless we reclaim this level and it acts as support, which I'm not ruling out, we could easily get back to like 235, consolidate, and then push back up and close the gap. But did it happen last time? I mean, it tried to, but then it failed. So if I was going to take a scalp from where we're at right now, and I was just going to say, I'm sure this is the bottom because we're going to print bullish divergence because Netflix is just 2 beaten down and Squid Game's 2's coming out or 3 or whatever. And I love Netflix, so I'm buying it. I don't care what you say. Okay, if you're going to do something like that, I would make your target like 250 or 260. So I would basically be targeting, a nice little like 25% move and then another failure to close the gap. So I would be ready to lock in those profits at basically what was key support because we gapped down below that support. So it's not unrealistic to think we push back up, try to close that support once we bottom, 25% move, but then it likely just rolls back over and goes lower. Because honestly, the real target on Netflix is 121. You're like, yeah, but you said the real target was 260 and now we're at 213. Yeah, exactly. So slinky theory in full effect. We go down, we go up. We go down, we go up. We go down, but we keep putting in lower lows. It's a slinky going down the stairs. And you know what? The next stair is down at 123. So you like Netflix at 213, you're going to love it at 123. Apple, still much stronger than the overall market is, but not looking particularly great. Definitely coming down. I mean, we talked about it coming down to 200 exponential and simple. We also have a support from that previous low. So 158, we'll see you there soon enough. Facebook, so okay, took out the low. So we've been talking about this, obviously the ascending broadening wedge. We took out the low now. So we know our next target obviously is 786 at 155. We know Facebook is trash. We know Mark Zuckerberg is trash. Lizard man. So honestly, does Facebook go straight to zero? No, I think it probably just bounces a little bit along the way. I don't think it immediately just goes straight to zero, but doesn't look good. I'm thinking Facebook at 156. Now, if this area was going to hold based on some bullish divergence, would that look likely? Well, I mean, the fact that we're lower right now, and when we look at this indicator oscillator, I mean, this was down at negative 26, and now it's at negative 6. So it has to go down another negative 20 and then go lower than this to not print bullish divergence. So what does that mean? Buy now? No. It means that at some point in time, when this decides to bottom and we start seeing a couple green histograms, it's probably going to be printing bullish divergence. Is that going to be at 160? Probably. Possibly. Somewhere around that level. At which point in time, the bullish divergence plays out, but it's counter trend divergence. So probably just pushes back up to where it's at right now. So if we can get a buy down here around 160, we can probably get a nice bounce about 20% counter trend. So that's what we're looking for. Looking for a potential counter trend bounce or if you have a position, you know, you're waiting for that bounce back up and then selling into it, you know, or shorting into it, you know, or options, whatever you're doing, looking for further downside. So, but we know earnings is on the 27th. Okay, so we know at the end of this month, things are going to hit the fan because we have big names reporting on the 27th and the 28th. So we have Facebook on the 27th. We have Google is the 26th. We have Amazon on the 28th. So we know basically the end of this month is going to be a shit show. So looking at Google next. Google obviously broke down from that key level. You know, we talked about it. We came down here once, twice, 3 times, 4 times, and then it breaks. The more times we consolidate or the more times we hit a support level, the more likely it is to break. Dude, if you spam chat, bro, you're going to get banned. If you want to type a message, type it one time. Don't keep spamming. You will literally get banned and never be able to comment on the channel again. So, I mean, is it worth it? You think I don't see the message if you type it one time? I'm in the middle of doing something, dude. Every single stream, I look at a bunch of different assets, including Bitcoin. So, calm down and just wait till we get there. I mean, it's literally the next thing we're going to look at. We have Google and Amazon, and then we're going to crypto. Thank you. Please do not spam chat, man. Come on. All right, so Google broke down from key support. We're basically coming down here to our target. So we know the target is the 236 for the macro. And we know once we hit that 236, which we're about to, we're basically confirming that we have a macro high in. So, I mean, at this point in time, we're basically looking at that Rona dump all the way to the all-time high. And now here we are about to hit the 236. So once we hit the 236, we expect temporary support, a bounce back up, retest what was support as resistance, and then after that, continuation and correction of the entire structure. So at this point in time, you know, we're headed down to 2337. After that, it looks like probably we'll get a bounce, come back up, retest here, and then we'll kind of ping pong around and then likely go lower to the 382. So still on track for the 236 target. Is that going to be a buying opportunity? Again, we'll have to look, you know, what would be a realistic bounce back up, probably just to retest resistance. There's not going to be much meat on the bone there. So I don't see much of an opportunity for a scalp back to the upside. Now, alternatively, if it did get aggressive, it came down to the 236, bounced all the way back up, a retest of a 200 exponential and simple, and the yellow resistance would be like 14%. So there's a little more there. But again, we're just now confirming into a bear market. So don't want to get too excited there. You know, a lot of these things are confirming in for the first time or reconfirming into the bear market. You know, we didn't get psyched out, obviously, because we expect that reversion to the mean play. That's the last good bullish trade before the bear market. So Amazon, you know, again, we see that rejection at 200 exponential and simple, the underperformance play. And now here we are back down at the bottom of the range. I mean, we've retested the bottom of the range plenty of times. So it looks like we're getting ready to go lower. The measure move for the channel takes us down to basically 2300. So that's our measure move. Alternatively, let's slap a fib on here real quick. If we go from the low from December 2018 to our high up here, you know, basically that's the 236 level. So we would expect the 382. So 25, 23 would be like a slightly more technical. I mean, measured moves are good, but horizontal, like technical supports are a little better. So that's probably what we're looking for the initial move. And then after that, we look at the 0.5. And then obviously we have key level of resistance in blue right here, like 2000. You know, and that's our macro target if Amazon decides to let go. Which, I mean, I wouldn't put it past it. Markets look so weak right now. All right, so continuing on. God, I'm tempted not even to do crypto because I don't want to reward this type of behavior, but everyone shouldn't have to suffer. Shinigami.
dude, you gotta just take it down a notch in the future, man. You're obviously letting your emotions take control of you because crypto is selling off. Not a good idea. If you start like trading or getting emotional, you're not going to be thinking rationally or reasonably, and you're going to make bad decisions. So I would focus on, psychology or possibly position sizing, because if you're that hurry to see Bitcoin as it's kind of like selling off, and it's not even like a horrible sell off, it's down like 3% today. You got to really look at your position size, man, because you may be overexposed to these markets. Don't be sorry. It's all good. Just don't do it again. But that being said, let's look at our Bitcoin futures chart. So obviously nothing has really changed right here. We obviously had a push back up. We tried, couldn't get above the 8 and 21 on the daily. We've rolled over the slope line. Everything's angled to the downside. It just looks rough. Not good right now. You bought it 50K. Okay. I mean, yeah, obviously not a good idea. I mean, I guess when you were coming back up to like 49, that probably looked like you were about to come back up and like at least be even again. But you got to look at like a lot of people probably bought at 50K or whatever, and then when they see price coming back up to it, they're looking to sell because they just want to unload that position and get out of it in case we go lower. So as long as we're below the 200 exponential and simple, and technically the 200 simple is flat right now, but 200 exponential is angled to the downside, it looks like we're going to just be putting in lower lows. So this was probably your selling opportunity to get out before it goes lower. Now, realistically, obviously none of this is financial advice, but we have the support of higher lows. So technically, until we take out one of these lows, you're okay. But if we come down here to like 37.4, it's going to look real bad because then we'll just have one lower low than that, and that's 35.6. But the bears are in control. This looks weak. And the fact that we're rolling over like this, taking out this low right here, we now have, basically higher highs and higher lows on the way up right here. And now it looks like we're starting to flip back over. So we have a high again, then a low, then a lower high. We don't want to see a lower low because then it looks like we're starting into a downtrend again. And if we flip over to our spot market, this was the levels we were watching from last stream. Again, sorry, this is so busy. The ascending triangle, or I'm sorry, the ascending channel that we have right here. This is our low in white, 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 and then here again, and now we're breaking down below it. Now, granted, this is the daily, so still got about 8 hours, but we do not want to see a close below this level. We don't want to see a close below basically 40K. If it close below 40K, it's going to look like we broke out of this channel, and we're done. We're not going any higher. So if we go back to upside from here, potentially targeting like 52K. But if we break down from here, it's going to look like we're headed back down to the lows. So we have some key levels along the way. 34.7, 32.3, something like that. 32.7 or 33K. Doesn't look particularly good though. Obviously, if we lose this level we're at right now, it starts looking much, much worse. But we see the 200 exponential and simple both angled to the downside. We had the hard buy signal, but didn't line up. We're below 200 exponential and simple. A hard buy below that level, much less reliable while they have a negative slope. We basically have a buy into a bearish trend. So sells are reliable on the way down. Buys are reliable on the way up. But we have red slope. I mean, everything looks bad. Crypto still looks terrible. It really does. There was some potential setups on like some of the alts, but we talked about it over and over again. It's really what Bitcoin does. And this rejection, this potential weekly 821 cross that got rejected, it looks terrible. And I mean, it's going to take us to lower prices. Almost at this point in time, I mean, 36K has to hold on a weekly. I'm not saying we're going to get there today, but this goes over the weekend, obviously. If we close this weekend below 36K, we're going back down to the lows. I mean, I would expect this at 30K. I would expect it to 200 exponential and simple. This is terrible. We had a push back up and a rejection, and that was the hard buy. That was the whole deal. A lower high, and now it's rolling over. 2 red histograms in a row. Weekly looks terrible. That 821 failing to cross was basically like the final nail in the coffin. But again, we've been talking about this monthly chart forever. You know, we were at the top at the 8. We came down to 21. Then we expect to come back to the 8, which we did. Then we come back to the 21, which we did. Then back to the 8, all in the same week, or month rather. And then here we are again, back at the 8. So the more times we do this, the more likely it looks like we're going to break. And we know that this was our 2018. You know, we bounced around between the 8 and 21. And people said this whole time, this is the bottom. This is it. There's a floor under Bitcoin. Bitcoin won't go below 6,000. 6,000 is the floor. Back into the bull run. It's been enough time. There's no more sellers. Sellers exhausted. And the next thing that happens, 50% dump in less than 2 months. So what happens if you get on 50% right now? Well, we go back to 20K. So expect 20K, not all at once, but it's probably going to happen pretty quick. If we lose this level, I would fully expect 26 and then 20,000, and very quickly. And when we look at this on the monthly chart, hard sell signal, Stokes angle to the downside, accelerating to the downside, knife is getting aggressive, all bearish. And then we look here, we have 1, 2, 3, 4, 5 months in a row of red histograms. And of the total recent months, we have 5 right here, 6, 7, 8, 9. So we have 9 months of red histograms, and we have 3 months of green histograms. And 5 of the red histograms are in a row. And we have clear bearish divergence on the monthly. So everything on the monthly chart, except for the 821 for now, says down. Bullish. Doesn't look good. Crypto market does not look good. It looks absolutely horrible. ETH looks like trash. Looks like it's headed back down to the bottom of the range. 27.38 on ETH would be probably my next target down. Again, below the 8 or the 200 exponential and simple, below the 8 and 21, all red, everything bearish on ETH. Total market cap looks just like the Bitcoin chart. Complete rejection, headed back down. We talked about it. We have to hold 2 trillion. If we don't hold 2 trillion, crypto goes straight to zero. Bankrupt, gone. Maybe not that low, but down, goes down. 1.8 trillion. So we didn't hold it. So we're headed down here to 1.66 trillion. Bitcoin dominance. Again, losing dominance right here. Just kind of consolidating in the middle of the range. We did get that little fake out cross to the upside, and now it just looks like, alts are probably just running a little bit right here while Bitcoin kind of chops around. If we get a big flush down in Bitcoin, though, I expect this to shoot up and alts to go down. If we get a big push on altcoins, it could easily come back down, visit the bottom of the range. Wouldn't surprise me to see a 4th drive of bullish divergence. So we're talking about Matic potentially getting that push back up here and getting rejected off the 200 exponential and simple. Obviously tried to push up and failed. Looks weak. It's just doing what Bitcoin does. Nothing really changed there. We talked about BNB and its potential to put in, that right shoulder. Again, not really doing much. Just kind of consolidating around this level. Looking weak below 200 exponential and simple. This chart looks really, really bad on the macro. AVAX, Avalanche, we're holding that key support right now, that ascending yellow support. But a breakdown below this and a close below this, on like the weekly especially, is going to look bad. On the daily, I would say it's holding for now. The likelihood of this trade is, it's getting less and less likely to play out, obviously. But, arguably, even better entry point on this. And we're still technically at the bottom of that range. Same with Bitcoin. We're still technically at the bottom of that range. So if you want to take a risk, if I was going to take a risk and buy support, this is where I want to buy it at the bottom of the range. Because then you have the whole move back up to the top of the range and potential high. But instead, people want to sell at support and buy at resistance. Because they're like, oh, it's breaking out, I want to buy. Oh, it's breaking down, I want to sell. Well, reverse the way you think. Solana, again, looks weak. Still got that potential to retest the 200 exponential and simple. But, this thing is just this thing is a turd. It probably retests 78. it's basically in the middle of the range right now. The alts really just need Bitcoin to hold up for any of these to play out. ADA, Cardano, again, just it's total trash, but there's potential for a scalp up here. I mean, there's no reason until the 8 and 21 start crossing back up on these things, there's no reason to assume they're going back to the upside. So if we're not closing above the 8 or the 21, there's no reason to be bullish on these things. XRP, I thought we deleted this from like the history books forever and agreed never to speak about it again. XMR, continuing to play out that trade. Looking a little bearish now, though. Pretty bearishly engulfing candle. I mean, it looks okay still. This was our previous low, and then it put in a high, and then it put in a low. So the real level to watch is, I mean, if this thing closes above 320, it looks really good. That's still a ways away, though. Is it topping out now? Maybe. It's starting to print some bearish divergence, potentially. Not on the MACD, but on the Jewel Thief it is. It's above the 200 exponential and simple. I mean, this thing still looks better than like any other crypto or most other cryptos. So, and what? That was a 65% trade, and it's probably halfway there. I mean, not quite as much now, but it was already up like 30%. So, it's definitely on the right track. All right, let's look at some commodities. Cool Sheet says, "What's up, bro? Bitcoin dead yet?" I mean, it's trying its best to die. It's definitely not pumping. Shinigami says, "Bro, Luna bullish." Shinigami says, "Bitcoin will go to moon in next 20 years." I mean, Bitcoin already went to the moon. It went to $70,000. That's not the moon, dude. You just don't have enough money. Like, if Bitcoin going from $3,000 to $70,000 wasn't the moon to you, you just don't have enough money to invest. You need to just work more hours and make more money and then use that to invest with. If a move from $3,000 to $70,000 isn't the moon, I honestly don't know what is. I mean, if you're going by Kathy Wood, like, $1 million, I mean, are you even to be rich if Bitcoin goes to $1 million? Like, how much Bitcoin do you have, dude? You should. It already mooned. It just mooned. The cycle just mooned. We just went from 3,000 to 70,000. So, I mean, I wouldn't be calling for moon bets now when all we see is weakness. But again, I think if you ask me legitimately, like, obviously I like Bitcoin. Obviously I'm a strong believer of Bitcoin. It's what got me into crypto space to begin with. If you ask me 20 years from now, is Bitcoin going to, right, is Bitcoin going to be worth $1 million, or is it going to be no longer the top market cap crypto? If I had to bet on one of those, Bitcoin is either $1 million or Bitcoin is no longer the top crypto by market cap. And let's say our time frame was 20 years. I would take the bet that Bitcoin is no longer the largest market cap. And it's not because I don't believe in the idea of Bitcoin or what it is or that it could put in new all-time highs again. It's because all the first movers of everything ever created, like technology-wise, which is what Bitcoin is, it's, technology, all go away. Nobody still uses, what was it called? MySpace? No one uses MySpace. Barely anybody uses Facebook. What about AOL? That's gone. What about the first cell phone? That's gone. Well, I mean, things go away in time. They get replaced with better things. We look at the white paper for Bitcoin. The white paper says, trustless transactions, peer-to-peer. Is that what's happening right now with Bitcoin? No, now it's a store of value. Things changed. You just don't get it. Okay, well, so the thing it was created for, it's not actually the best at, and now other things do it better? So it's going to hold its value because of network effect or first mover advantage? I don't think so, man. I don't think so. If you're in a technology space, people are going to buy the thing that does the stuff better. So in my opinion, is the top crypto in 20 years even invented yet? Probably not. Are a bunch of other cryptos going to come along that we haven't even heard of yet? Or maybe ones that are already out and do things that Ethereum was supposed to do better or Bitcoin was supposed to do better? Probably. So if you can pick which crypto is going to be the future, you're probably going to be super, super rich because it's probably super cheap right now compared to what it's going to be in the future. But is it Bitcoin? Probably not. Probably not. I mean, I'm like, you guys know I talk a lot of trash about altcoins and obviously believe a lot in Bitcoin, but the truth is, Bitcoin probably doesn't win in the end. Let's be realistic. It probably doesn't win in the end. But that being said, let's look at gold, XAU. So we see that weakness out of gold. We're talking about this basically putting in the top. We took out this micro top right here. Do I have the fibs on this chart? Yeah, okay. So we got basically rejected exactly at our target. Thought it was going to take a little longer to get there. We obviously bounced up pretty quick. But that is our 382. Or depending on which direction you're looking at it from. Sorry. This was actually drawn from the top to the bottom. But you could draw it from the bottom to the top. But that is actually our 786 fib. Basically just got rejected right at it. Back down at the heart line. So we see strong resistance at the heart line, strong support at the heart line. So I think this continues to just melt down and stay inside this channel for a little while. But eventually that could be bullish as it could develop into a cup and handle. But this thing, you guys know my target down here. I expect gold back at like 1860. I wouldn't be selling gold right now, but I'm not sure that I'd be necessarily like stacking up on it either. Because this could be another like 6 months, year, whatever, just kind of going sideways down. Silver looking weak. It's barely hanging on to the 200 exponential right now. Last thing we want to see is the silver close below $24. Do not want to see silver back below the 200 exponential and simple. It's going to look absolutely terrible. And then gold silver ratio. This is the scenario we talked about. Until we took out the lows right here and then threatened one of these lows. Didn't want to get bearish on this because we're just consolidating at resistance. And now we see this big, thick, green, juicy candle pumping straight through the 200 exponential. And where are we probably going? Probably going to the 200 simple. And then once we get back to the 200 simple, that's 1 test, 2 tests, 3 tests on it. And we probably break to the upside. And then I'll finally be right on this one. And we're probably going to go to about 90. That's my target, is the 0.5 and around like that 90 level. It has been for literally like, I don't even know how many months ago we drew all this on here. In March of 2021. So it's been a while. Been like a year ago. It's basically just grinding up towards our target. Everything looks according to plan. XPD consolidating above the 200 exponential and simple, showing some weakness. Don't love how this chart looks. XPT, there it is. Finally letting go, just melting down, turning back into the trash bag metal that it is. Straight up garbage. The worst metal by far. They must not use this for anything anymore. Literally nothing. This thing is so weak. And people have been talking about how this is undervalued for years. There's a reason it's undervalued, because it's trash. It's garbage. It's useless. That's why you got to diversify. Don't just buy everything. People are like, oh, silver is historically the cheapest asset, so I'm going to go all in on silver, because eventually it has to come back. Eventually, sure. It might be a 100-year cycle. There's a reason things that look terrible continue to look terrible, because nobody wants them until they look good again. Speaking of, let's talk about pot stocks. ACB, back down, revisiting the lows. As expected, as discussed, as predicted, these things will continue to just make lower lows. Continue to just make lower lows. Look at this, Tilray trade. 50% profits, took it, and now where are we at? Back down at the lows again. Absolutely terrible. New lows for Hexo. Trash, garbage. Long term, love the pot stocks. But short term, come on, guys. They're just going to keep making lower lows. And now we see uranium has rolled over exactly like we discussed as well. So basically everything we've been talking about for the last week or two has played out basically perfectly. So I would say we should just stick to our current narrative, see what's going on here. So we got that final pushback up on some of these uranium stocks. Some of them put in a new high. Some of them did not. We basically made it to our targets. So now we're looking for that buying opportunity when these come down. But we're going to look at the longer time frames as well. because we don't want to get too greedy on these. We saw bearish divergence developing at key levels. Obviously going to be looking for key entries once again on these. This is URA. Again, looking very, very toppy. I mean, these things have been getting killed, huh? I mean, they had some nice moves up here, but already back down another, what, 15%? Yeah. UEC, same thing. Put in a high, rolling back over. We want to look at the 200 exponentials first. Bearish divergence on all these. No surprise that this is happening. UUU. Looking like a double top, essentially. Just rolling over. Again, triple bearish divergence playing out perfectly. Potentially going to load back up around like that $7 range, maybe. And then UROY, this has been the big underperformer. Breaking down below the 200 exponential and simple. Losing slope here. So I don't know if this one is just telling us something or if it's just underperforming in general, but man, UROY is not looking great right now. I mean, it's looking great for a buying opportunity. You know, if this thing keeps melting down, that's what we want to see. I mean, what do we have for 241? Yeah, I mean, and that was we were at $5 when we were talking about 241. That was a 50% drop. Now it's at 365. It doesn't look that unrealistic now. So we'll look at some of those key levels. Keep watching these. I'll keep doing the uranium updates as we are going to be looking for some entries into these into the near future. And then obviously we'll keep looking at pot stocks as they kind of just melt down. But yeah, I think that's it for today. I think that was all I had on the list. Shinigami says, bro, it's mining is limited and halving. Sure, there's a fixed supply of Bitcoin and there's halvings. I mean, I don't know what your point is, though. The only issue, my main issue with Bitcoin is, Shinigami, that makes me think there's a definite possibility, I would say probably 33% chance that Bitcoin will never go to zero. I mean, maybe it will. There's a possibility it goes to zero if it's like hacked or something crazy like that, you know, or whatever. But there's always going to be a cult following with it. So I really don't think it goes to zero. But there's at least a 33% chance, I would say, just roughly pulling it out of, you know, my head or my other orifice. I would say there's roughly a 33% chance that Bitcoin just fails. I mean, just nothing goes wrong with it. It doesn't just, like, it doesn't screw up or anything. There's no big, like, catastrophic event. It's just people move on to other stuff that's more important because it's too expensive or it's too slow or, you know, they don't need it. So here's the thing. You're saying, but the halving or the halving, diminishing returns, you know, the problem with the halving is that what's the demand for Bitcoin for? What do people actually use Bitcoin for? They use it as a speculative asset. So there's plenty of speculative assets. So that doesn't work anymore. So you're like, yeah, but people are still going to speculate on it because they like it. And it's digital. Okay, sure, there's plenty of other things you can digitally speculate on. And you're like, yeah, but there's only so many of them. And there's only 21 million. Yeah, but now we paper trade it. Now there's futures contracts. So what is a futures contract? It's a derivative. So every argument that everybody makes, all the Bitcoin people make all these arguments about gold as if gold has failed and Bitcoin is going to do better than gold. But everything that happened to gold that made it quote unquote fail, like paper derivatives, you know, obviously the big thing with Bitcoin is it's the gold of the future, it's digital gold, and it's better because it's digital. So, and there's only 21 million. So that's better. But really, Bitcoin was designed after gold. That's why they call it mining. That's why there's a limited supply. That's why there's all these things. It was designed after gold. It's designed to mock gold or like replace gold or emulate gold. But everything about Bitcoin is worse than gold. You know, it has a shorter track record. It's you know, not even 20 years old. Gold is thousands of years old. People are like, yeah, but there's unlimited amount of gold. They can just keep mining it. Well, is there an unlimited amount of gold? No, there's only so much gold. It's just in the ground, so we don't know exactly how much it is. But there's only so much. We can't figure out how to make gold. We don't have some machine or some chemist who can put a couple things in a pot, stir it around, and drip some liquids on it, and then turn, lead into gold. There's only so much of it. The same way there's only so much Bitcoin. The only difference is we know there's 21 million Bitcoin. We don't know how much gold there is, but there's only so much. We know that for a fact. You're like, yeah, but there's gold in the atmosphere flying around. Well, you know how much it would cost to bring gold out of space onto Earth and then use it? The gold would have to be so ridiculously expensive to ever make it worth mining space gold that at that point in time, gold would have already won. So if your argument is that there's space gold, so gold will be useless because there's so much of it, well, in order to even be worth mining space gold, it would have to be worth, $1 million an ounce. So at that point in time, gold already won. So that's just a stronger argument for gold. So every argument for Bitcoin, and then you're like, well, gold is manipulated. It'll never go up because of all the paper contracts. And you're like, okay, that's true. People are able to use derivatives to manipulate gold because now you have a whole market where people are buying and selling actual gold. And then you have a second market, which is the derivative market, where people are betting on the price of gold. So instead of actually going out with those dollars and buying gold, or instead of going out to the market or pawn shop, whatever, and selling your gold to move the price up or down or to speculate on price, you literally just bet with someone else on a futures contract or on a derivative paper contract. And you say, I bet gold's price goes up. And they say, I bet gold's price go down. And then you each put your $100 in the pot. And then if gold price goes up, one person takes both hundreds. And if it goes down, one person takes both hundred. So that's what Bitcoin is now. Now Bitcoin has all these different things where you can bet on the price of Bitcoin without actually buying Bitcoin. Like if you go on Robinhood and you buy Bitcoin, you don't actually get Bitcoin. You're just speculating on the price of Bitcoin. If you go on PayPal and you buy Bitcoin, you don't actually get Bitcoin. Nobody goes out and purchases Bitcoin on the spot market and then gives it to you. No, you just get exposure, quote unquote, to Bitcoin through betting on the prices, which is a paper contract, which is a derivative. There's no actual Bitcoin backing that. PayPal doesn't say, oh, he just bought $23 in Bitcoin, so we got to go buy $23 in Bitcoin. No, they don't do that. They just say, okay, yeah, sure. You get exposure to Bitcoin. So all these paper contracts that let it so they could manipulate gold, that's been the problem with gold for 20, 30, 50, 100 years, that people are like, oh, gold and silver, it's manipulated because of paper contracts. Oh, the futures. It's all on Bitcoin now. And the Bitcoin people, the cult, has been praying for this. Every night before they go to bed, they kneel down on the ground and they pray to the Bitcoin Jesus. And they say, oh, Bitcoin Jesus, please let us get, futures contracts on Bitcoin. Please let us get, exposure to Bitcoin. Please, just let mainstream get into it. But that's bad. It's paper contracts. So it's literally just people betting on the price of Bitcoin without having actual Bitcoin. And you're like, yeah, but it's going to be a physical backed ETF. Well, there's no such thing. There's ETFs for Bitcoin, but there's no such thing as a physically backed Bitcoin ETF. And even if there was, what are they going to do? They're just going to be like, oh, okay, yeah, sure. Okay, you cash out your Bitcoin contract. Bitcoin is $40,000. Here's $40,000. Go buy your own fucking Bitcoin. Because there's no reason. With gold and silver, there's a reason to have a futures contract, and then you get it locked in at that price, and then you can ask for physical delivery of it, and then there's costs associated with that. With Bitcoin, there's no reason to have a futures contract. It doesn't benefit anything. It was like, now you can get exposure in your 401k. Now you can get exposure. The ETF doesn't matter, and it's not a good thing. Literally everything that the Bitcoin people are praying for is bad for Bitcoin. So now you say there's 21 million Bitcoin, so it has to go up in price. I say there's 21 trillion Bitcoin now. Because there's 100 to 1 leverage. You don't even have to buy Bitcoin anymore. You can just speculate on it. So in my opinion, Bitcoin's already dead. It's already dead. There's derivatives. There's paper contracts on it. And then that doesn't even take into account like Tether. I mean, what is everything about Bitcoin that you're like, oh, there's only so many. There's only so much money. There's no fake making money. Well, now you have Tether printing up money, making as much as they want, and then buying it up, propping up the price. So isn't that the same thing as a central bank? Isn't Tether just the central bank of crypto? Aren't they just printing money out of thin air? Not getting audited, not following laws? Isn't that literally what a central bank does? So every argument that you have against like the actual system applies to Bitcoin and crypto. So, I mean, in my opinion, it's all been corrupt. It's all ruined. None of it, none of the arguments, none of the narratives make any sense or hold any clout long term if you actually think about them reasonably. So that's my main argument against Bitcoin and why it doesn't have to go to 1 million. Somewhere around the way, there's going to be a crypto that's useful, that people want for something and need for something. There's no actual use for Bitcoin. Nobody takes Bitcoins at the end of the day, breaks them down, and then uses them to power spaceships that they fly to, the moon with. The only thing people do with Bitcoin, the only purpose that it serves is a speculative asset. And you're like, yeah, but it's a store of value. But you can store your value in anything. You can store your value in anything. And you're like, yeah, but it's the best because it always goes up. Well, that's not storing value. That's speculating. The best store of value, historically speaking, is gold. Because gold always trades in a certain amount of, exchange rate to other commodities. So you want a bunch of corn because corn's going up in prices, but you can't just put a bunch of corn in your backyard because it'll get moldy or birds will eat it or your neighbors will steal it or whatever the reason is. So what do? You just buy gold and then you use the gold and then you trade it for corn as you need the corn. Bitcoin doesn't do that. Bitcoin doesn't have a purpose. It doesn't have a peg. It doesn't have a historical value or ratio to things. So you're like, yeah, but what about the gold? Or what about the Bitcoin to Ethereum ratio? Sure, okay. It just doesn't, there's no argument for it that works anymore. So again, I'm not saying there won't be in the future. I'm not saying things can't change. But every narrative that the Bitcoin and crypto community has had since inception has failed. None of them are real anymore. So if you're like, well, smart contracts in the future, sure, show me the smart contracts. And you say, well, one day it's going to be used for, the trustless payments like it was supposed to once the Lightning Network is up. Sure, okay, maybe it will. But right now, doesn't look good. Doesn't look good. Shinigami says, ETH is unlimited, right? Sorry for dumb questions. Yeah, technically it's unlimited and no one knows how much there is. Thanks for the analysis. Love you, mate. Yeah, for sure, buddy. Big D says, hey, man, did you see my Kathy Wood meme, by the way? No, I didn't. Where'd you post it at? In the group? I did not see it. Oh, I don't know. Where'd you post it at? I'll have to look afterwards or whatever. You have to let me know. Yeah, I'll hold on for a sec. Yeah, I'm not sure. I didn't actually notice any Kathy Wood memes. I did see somebody posted an article about Michael Saylor or MicroStrategy selling Bitcoin though, but I didn't actually have a chance to look at that, so I'll have to take a look. But yeah, I mean, that's pretty much it for today. I'll hang tight for a Big D for a sec. I don't know. Can you post a meme in? Oh, post it on the previous video? Okay, I'll take a look at it. No, I didn't actually notice it yet. But yeah, gonna go ahead and wrap it up there. It is 12:46 Eastern Standard Time on Friday, April 22nd, 2022. I am Crypto Trend Trader. And remember, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research. Trade responsibly. Careful with narratives and fundamentals and all this stuff. Careful listening to the talking heads. Careful listening to people making direct statements as if they were fact without any factual backing, such as the Fed can't raise rates because there's too much debt and they won't be able to service it. So when you hear these strong, definitive statements, if you don't believe me, look into them and see, okay, is there a possibility that this statement is wrong? Because if you take that as an absolute fact and then it turns out to be wrong, the entire premise of your whole argument or fundamental case or whatever could be invalidated. So before you build your house on a foundation, make sure the foundation is solid. So whatever the foundation for your technical or fundamental argument is going to be, make sure you research that thoroughly. And then once you completely understand that and the dynamics of it and what could change, how you would be validated, how you'd be invalidated, then go ahead and build on top of that. But if you start with some soft, squishy, foundation, don't be surprised when it all caves in and you lose everything. Because that's what's going to happen for all these people that say the Fed can't raise rates because X, Y, Z. They're all going to be wrong. I promise you this. Even if the Fed doesn't raise rates, they're still wrong. It just means the Fed doesn't raise rates. But I promise you that anyone who thinks that the people who designed, the architect who designed and control the entire system, the monetary system, the global system, if you think for 1 minute they can't figure out a way to change the rules or just use existing rules and do something they've done in the past or never done before and change it, you got another thing coming. Because I'm telling you, the Lindy effect, the longer something has existed for, the longer it is likely to continue existing for. That's basically summed up. So we've had this global financial system for, depending on how you look at it, 10s, 20s, 50s, hundreds, thousands of years, depending on how you look at it and which portion of it. So the likelihood that it just ends this year or next year, in 5 years or 10 years, we no longer have a global reserve currency, or the stock market all, melts down and that's it, it crashes, and then we go into Mad Max anarchy. Those things are not likely to happen. And then when they do, they happen once, and by then it probably won't matter. So the longer something has existed for, the longer it's likely to continue existing for. So just keep that in mind when it comes to the Federal Reserve and them servicing debt or whatever. Just because we have a 40-year potential breakout of, the Treasury yields, or a crash in bonds, or inflation that we haven't had in 40 years, or the strongest dollar that we've had in 40 years, doesn't mean it has to turn around right now because it's at resistance. We don't want to try to call the tops and the bottoms on these things. We want to let the market tell us what it's going to do, and then we want to just ride along with it. But that being said, going to go ahead and call it from there. Appreciate everybody tuning in. Thank you all for watching, participating. Some of you participating more than you should have, but that's okay. I definitely appreciate everybody showing up today. Everybody have a nice weekend. Protect your principal, protect your capital, lock in those gains. Obviously, none of this is financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. Crypto Trend Trader with our Friday stream. I'm out of here. Make sure to tune in Sunday from 8 p.m. till 10 p.m. Eastern Standard Time. Wednesday from 8 p.m. till 10 p.m. Eastern Standard Time. And of course, Fridays from 11 a.m. till roughly 1 p.m. Eastern Standard Time.